Welcome back to In Business. Earnings season begins today when aluminum giant Alcoa reports after the close of trading. Right now, I'm joined by Don Hayes. He's the chairman and chief investment strategist at Hayes Advisory Group, where he manages more than $1 billion. Good morning to you, Don. What are you expecting here when we kick off earnings season? Is it going to be an affirmation of an economic recovery or a reason for profit taking on your part?
Well, the earnings themselves are going to be very, very good. Now, the market is overbought, and so you could have some sell on good news type thing, but it won't be very significant in our opinion. If it is a pause, it'll be just a pause to refresh and should be used to purchase stocks.
Well, are you going to be purchasing? And if so, what are the sectors, what are the stocks that have you most interested right now?
We are going to be purchasing. We've been fully invested. We've raised just a little cash, maybe 8% in our portfolios, just on the chance that the market might just pull back a little bit from the very overbought condition. But we're very interested in anything economically sensitive, and right now industrials are looking very, very attractive. Financial stocks are good, especially the ones that are involved in all this merger acquisition type of activity. But really, you can go all across the board. Energy is a overweighted position here, but we would concentrate more on industrials and financial stocks at this point.
You're saying that the market is overbought. You could expect some profit taking on good news. How much of a correction would you expect? And where are we more broadly? If you are feeling like you can continue to put money to work, where in the bull market cycle are we?
Well, bull markets, if you look back for many, many decades and cycles, traditionally bull markets have 3 phases and sometimes a 4th. We think you've just ended the first phase. In fact, Friday was the first day that eliminated in the Standard & Poor that crisis panic selling that started on September the 29th of 2008. We're just right back there, and nobody's been buying stocks. So you're back to the starting point, and a lot more cash is sitting on the sidelines now than you had back in those days. So there's a lot of fuel still remaining to push this bull market in the months and years ahead. You
said you are hedging a little bit. You got a little cash there in your portfolio. Given that we're seeing, you know, the 10-year yield at the highest level since 2008, are you looking outside of equities a little bit more right now?
Well, you've got the 10-year yield that's moved up, but you have to put this in perspective. Back in the good old days, back in the 1980s, you saw that 10-year yield at 15%, and now right in under the 4% level, so very cheap. But if you're looking where where the value certainly is not in the bond market today. It is in the stock market, and our valuation composite is showing the market still very undervalued.
Well, given that we're still not necessarily out of the recession, according to the latest word that we did get today by the NBER, what do you make of whether the market's sort of anticipating economic recovery or whether it's leading the way here, as Alan Greenspan said?
Well, the market always leads. It's not a lagging type of indicator. One of the better leading indicators. And yes, every day you get a different take on that.
Is it a true read, though? Market always anticipates. The market always moves ahead of the economy, right? But is it a false read? Is it a sugar high?
Well, you have to look at who's doing the buying. And so if you have the public or the speculator doing the buying, that is something you might want to doubt. But when you have the market still in a high fear cycle, and that's exactly where we are today, there's more cash as a percentage of the stock assets than we've ever had in the history. And so you're having the fearful people are still on the sidelines, and the smart people are doing the buying. We do the smart investors versus the dumb investors now. And it's not the dumb investors that are buying. It's the smart people, the ones that are highly liquid type of people that are putting their cash on the line.
Yeah, and it's interesting to see some deal activity perhaps starting to bubble up in here as well, Don. Thank you so much for making time for us in your schedule this morning. Don Hayes joining us. He's, of course, the chairman and chief investment strategist at Hayes Advisory Group.